Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview. So every other week of the market's key events and trading opportunities. Whilst I'll just let you look at the disclaimers, of which there are two, I'll just run over some of the key objectives of this webinar. We think markets are primarily driven by themes which buyers and sellers relate to in order to enter and exit markets. These themes can be stories or narratives that can be long-term or short-term, medium-term fundamentals or technicals even that increase or decrease in importance over time. I'll just move on to the next disclaimer, just so that you can have a look at that. Our goal really is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way and write them in the box. Otherwise, please write them, send them to us, and hopefully we'll get to answer those as soon as possible, or at least after the webinar finishes. It is just after 11 o'clock in London. It's Wednesday, November the 9th. So let's get to it. I wanted to start actually just generally on markets, where markets are positioned. Obviously midweek, second week in November, positive sentiment really we've seen overall this week actually. European stocks though today are more mixed. Investors really mulling over these US midterm results. Kind of not sure how much of an impact they will have actually, but there's obviously been a lot of chatter about whether the Republicans will take a clean sweep, although at the moment that Republican wave hasn't seemed to have materialized. We're also getting probably the bigger driver in the near term has been obviously reports about the loosening of the China zero COVID policy. Kind of conflicting reports for us actually. We had on the weekend the China Health Ministry confirming that China will maintain its present zero COVID regulations, but then also improve the pandemic control measures. So that kind of hinted that protracted lockdowns may be avoided. And certainly this is what risk markets are taking as a positive. But then it's kind of as well hard to interpret China's health policy really, and certainly some Chinese officials have already pushed back against any speculation that will drop that zero COVID policy. Regarding the midterms then, the sort of near-term kind of driver or not potentially, Republicans, they're likely to at least take the House, but it's been a much closer Senate race than expected. As I said, overall, that wave, the Republican wave, really has failed to happen, really, and the race generally has been much closer than expected. For FX, we kind of hinted, yeah, limited impact really. We've seen already the start of this week, stocks rallying really on the back of potential Republican control of the Congress. And that's what we've seen. And then that's kind of impacted the dollar really, where we've seen a small sell-off in the dollar over the last few days. But for stocks, then the split in Congress means it's potentially harder to pass legislation over the next or the coming 2 years, really. Although we do note that has favoured stocks with indices higher 6 months after midterm elections historically. Overriding all of this really is the overall sort of risk equation, if you like. It's this search for a higher Fed peak in interest rates, and then quite elevated uncertainty still around the sort of medium-term economic outlook and potential recession, obviously allied with the energy crisis, which is slightly taken a back seat, certainly with the sort of warmer weather in Europe, giving hope to some that things won't be as bad as predicted even just a few weeks ago or a few months ago even, when we we had sort of a catastrophe type thing being envisaged in Europe, especially with all around the energy crisis. Okay, I just want to concentrate firstly on equities, and as we mentioned in our preview, actually the divergence really between the old economy and new economy, and for indices in the US especially, that means we've seen this outperformance of the Dow versus the tech-heavy Nasdaq. So old economy stocks, they comprise those that are value-based, they're value stocks, which you may have heard of, and these typically perform better due to their stable earning streams. These companies, they're usually larger, more established, and which are then they're inherently less risky and less volatile, and they offer capital growth and they pay dividends. And this is where investors really are gravitating now, especially since they are less sensitive to interest rate increases, and then they historically outperform in recessions and bear markets. On the other hand, of course, the new economy stocks, if you like, are high growth tech names, growth names that are prone to fears of rising interest rates. And that's because many of them are value based on their projected profits far into the future, i.e. on their growth, of course. And as the Fed certainly forges on with its most aggressive tightening monetary policy in decades, then the future profits of these tech firms will be worth far less. And this is certainly what we've been seeing over the last few weeks. And even last week, actually, specifically, if we look at that, the equity rally certainly lost steam, although certainly as well recouped some of the losses on Friday. The S&P, the broader S&P, if you like, the benchmark was up 1.4%, but it still had its biggest weekly decline since late September. And it was really around these concerns, which we'll look at in more depth when we look at the Fed meeting from last week, but concerns over a higher endpoint for interest rates, which really weighed then on technology stocks and are certainly more sensitive to elevated borrowing costs as well. The Fed, in effect, played both good cop and bad cop. Obviously, Chair Powell guided hawkishly, sending equities lower. But then we also had some several Fed speakers actually striking a slightly more dovish tone, or markets took it as being slightly more dovish, and that lifted equities into Friday. And certainly we've seen that this week, maybe on the China news and also the midterm elections that we've just talked about. But importantly, growth underperformed value last week by 4 percentage points, and that's the worst 5-day session for growth this year. So although the Nasdaq that closed higher, 1.3%, I think, on Friday, suffered a 5.6% drop last week, and that was the biggest decline since late January. So I've got the chart here actually of the Dow. So you can see on the weekly chart, just on these bar charts here, you can see 4 weeks of gains. We've not seen that for since, well, going back over just around a year ago, actually, 4 weeks of gains in the Dow. This is, again, old economy stocks, if you like, value-based stocks. And certainly that's been a real strong boost in the last 4 weeks, as we say. If we look at the daily, we can see we're now above the 200-day moving average, always a widely looked at simple moving average. We're above that 200-day moving average at 32,554, and really, if we get above these August highs around 33,364, then we're aiming actually for the August highs then. The August highs rather than the late August highs, if you like, but the mid-August highs. We're up above 34,000, so potentially we're looking to push above that. And you can see this real strong bounce through various moving averages. That's the 21-day, then the light blue is the 50-day, then the 100-day, and even then the 200-day, as I've just said. So a strong bounce from these October lows, late September lows, which you can see at 28,715. If we contrast that with the Nasdaq, tech heavy, of course, and we're still struggling to get above the 21-day moving average, really. You can see there, this light blue line capped the upside in September. Then early October, we did get above that, late October, start of this month, but again, dropped below there towards these lows. And we're just sort of hanging around below the 21-day moving average and also below that mid-June low still, or hanging around that level, 11,059 actually, that level 037, so just above that mid-June low, but really struggling. And the contrast with the Dow, you can see, is stark, really. For the Nasdaq, then we've got the 21-day moving average as resistance, initial 11,114. Then we've drawn in a couple of fib levels potentially as resistance, probably bigger one, 38.2, tallies with that October high, 11,693. Before we then possibly get above there towards, say, the 100-day moving average just below 12,000. But you can just see, and really good, I think, to point out this difference between old economy, new economy value and growth, and potentially then what happens with the Fed, whether they slow the pace, but rates, the peak rates are higher. Markets wake up to that fact then, and the Nasdaq turns lower again potentially. Okay, we think it's worth then, of course, moving on to last week's events. Firstly, we had the non-farm payrolls. Just want to pull up, first of all, the unemployment rate, still near 50-year lows. But the headline number in non-farm payrolls, 7th straight beat, actually. Headline gains of 261,000, above expectations of 200,000, but slowed from last month's 315,000. And they were revised higher, actually, from 263. I think the 3-month average now is around 289,000. The yearly average is above 400,000 now. That's for the headline non-farm payrolls number. So certainly we are slowing, and sustainable sort of monthly gains of this type really are, as we move into a slowdown, are unsustainable, really. Above 400,000, really, that is punchy, and we will get slower, probably lower prints as we go into year end and probably next year. That said, of course, job gains were broad-based, actually. Strong gains in healthcare, professional and business services and manufacturing. We had wage growth, actually, that held up strongly as well, coming in at 0.4% month on month in October, from 0.3% previously. Although the year-on-year figure actually was a touch softer, 4.7% versus 5% previously. The market reaction, we've got the chart here, actually. The unemployment rate ticked up to 3.7% from 3.5%, and it's expected at 3.6%, basically on a rather weak household survey, although it was met with a 0.1% decline in the participation rate to 62.2%. But definitely markets focused on this sort of tick up in unemployment. But you can see here, something we want to highlight, we're still near the 50-year lows there, 3.5%. And you can see this chart going way back, and you can see we're still very, very low, actually, in the unemployment rate still. But as I say, markets focused on, and especially stock markets focused on a slight tick up in unemployment, even though we had a pretty solid headline gains. And certainly going forward then, especially in, say, tech, be interesting to see how that impacts some of these layoffs in tech announced, Meta potentially, Twitter, of course, grabbing the headlines, whether that impacts headline non-farm payrolls, of course, going forward. And then after that, then the Fed's tightening path in the months to come. Now, let's just focus briefly on the Fed from last Wednesday, of course, a week ago, but certainly important. We're going to get these webinars every other week, and it's certainly an important driver of markets, we think, underlying, say, this near-term optimism and more positive risk sentiment this week. The Fed, of course, they raised, as expected, 75 basis points to 3 3/4 to 4%. But it really was a meeting of two halves, and it's probably instructive really to look at this market reaction as potentially a bigger sort of driver of markets if we do get this Fed pivot, or we do get more Fed rate hikes and a more hawkish feel to the Fed going forward. But the two halves really, firstly was the statement. The Fed statement hinted that more hikes would most likely be at a slower pace, so that's 50 basis points. And it said the Fed will then consider, well, kind of three things, and these certainly grab the headlines when determining the pace of future rate increases. So it said the Fed at the FOMC would take into account the cumulative tightening of monetary policy, also then the lags with which monetary policy affects economic activity and inflation, and then also economic and financial development. So that's kind of incoming data, if you like. And markets really rationalized that with rates in restrictive territory already, the Fed can kind of downshift potentially to a slower pace of normalization to assess, of course, the impact of basically 375 basis points, 3.75 percentage points worth of rate tightening that, of course, has been pretty much unleashed since March. And we saw really a wave of optimism flushing over markets. Equities jumped, the dollar and US bond yields tanked. And you could see that on this chart then, the dark blue line, 2-year US Treasury yields, they track the US Fed funds rate most closely. And you can see those tank actually from sort of 4.56% down to below or near 4.4%, 4.44. But just this drop in yields and then this sharp buying phase, if you like, in the S&P sort of jumped over 1%, I think, immediately after the statement. Enter the second half, if you like, enter Powell, the second half of the Fed meeting, and really the Fed chair, he confirmed that actually future hikes could be of a smaller magnitude, but may not be straight away. They may come at the December meeting or the one after that. But he then said the incoming data since the last meeting suggests that the terminal rate, the peak rate, if you like, in Fed funds, in the US interest rates, will be higher than the 4.6% it was penciled in the September dot plot. And that he actually also then said a pause is very premature to think about. Really kind of then Powell's task, if you think now, was probably to announce a slowdown without suggesting that we're at the beginning of the end, really, and that hopeful pivot. So that pre-press conference market reaction really shows that this would have triggered quite a full-on risk-on rally otherwise, and that would undo part of the previously delivered tightening. So for Powell, really, then this pushback that we saw after he spoke was pretty obvious, and you can then see in the charts stocks really tanking. They closed lower by 2.5%. I think the S&P, the Dow was off 1.5% or so, and the Nasdaq really hit down 3.3%, I think, on the day. And then you saw again 2-year yields. So this is 2-year Treasury yields then do a quick about turn, a quick U-turn, and they went sharply higher and above where they previously were towards sort of 4.6% or so before actually pulling back. But interestingly, we're still there now actually on those yields around 4.66%, I think. for the 2-year. But just really highlighting this sort of market reaction of two halves, potentially the reaction we will get when they do pivot, and then of course the reaction to if they're hawkish and they remain hawkish, and what happens. Kind of going forward then, a few points to note really around this speed. The speed of hikes is becoming less important, and really that leaves the market to infer that the Fed just keeps hiking at more meetings if the incoming data supports that. We also must remember that the Fed has cranked up the pace of quantitative tightening in the background. That's QT, which provides its own tightening pressures on markets. And actually arguably equates to several hundred basis points of rate tightening over the course of the year. And then thirdly, the Fed has now raised interest rates, kind of touched on this, 3.7% this year. That's the fastest pace of policy tightening since Paul Volcker led the Fed in the early 80s, late 70s, early 80s. And really just this danger kind of forgotten, but we do need to think about it in the background, potentially this danger that the harder and faster a central bank moves into restricted territory to get a grip on inflation. Of course, the idea is that this slows demand, crimps demand, but potentially then the central bank has less control over the outcome, and then the greater chances of a bigger slowdown and the recession. I think near term then, interestingly, as I kind of touched upon, we did get other senior Fed figures after the meeting beginning to ease the rhetoric slightly. The central bank has finally acknowledged that policy acts with a lag, and you kind of would have thought that they would understand this for sure. But the Fed has now, the rhetoric as it has eased, then we do potentially see this lag, and we did get several speakers, a few speakers actually on Friday. We do get them all this week as well. Policy entering a new phase, and it could require smaller rate hikes. I think Barkin at the Richmond Fed as well said that the central bank may slow its pace of increases, but then also said that they may need to raise rates above 5%. And you can see on this chart actually just this pivot or non-pivot then, because this peak rate in Fed funds has gone higher above 5%. We touched upon it sort of middle of October, but now we're peak rates are sort of around 5.2%, I think. So potentially then this is what will be the driver potentially for the dollar. We've had this correction, but as we think, as markets realize that rates are going to stay above 5%, we get a smaller pace of hikes potentially, but also then a higher peak rate. Then this should support the dollar, and especially if other central banks go slower and not higher in the medium term. Okay, just moving on to the US CPI. You can see here this is key data, obviously out on Thursday. Tomorrow, analysts expect actually headline consumer prices to pick up by 0.7% month on month in October, accelerating from 0.4% month on month in September. The core measure is seen cooling a touch to 0.5%, so lower than the 0.6% in September, but still elevated. And this chart really highlights that fact pretty obviously. You can see the core, the dark blue line, and then the yellowish orange line is the headline rate. You can see really elevated, really still sticky as well. And this is probably the issue going forward, even though we may get a pullback at some point in the coming months. We're still elevated and sticky. Certainly then the data will be framed in the context of how much progress the Fed is making towards lowering inflation. After the meeting last week, Chair Powell noted that inflation remains well above the Fed's longer run goals, and with price pressures evident in goods and services. And although longer term inflation expectations still appear well anchored, actually, the Fed wants to see inflation coming down decisively. And as we've said, it's prepared to stay the course until that job is done. And certainly the message from Powell regarding inflation is that really the FOMC is strongly committed to bringing inflation back towards its target. Let's not forget, which is still a 2% target for the headline inflation rate. For December, markets kind of split between a 50 basis point hike and a 75 basis point hike. Kind of coin toss, slightly odds in favor of a 50 basis point hike. I think at the moment slightly slipped towards, I think now around 56% the odds for a 50 basis point hike in December, as opposed to 44% or so for a fifth consecutive 75 basis point hike it would be in December. Markets really, they seem to be of the view that if inflation metrics move lower, and then we probably need to look at sort of aggregate inflation data. So that includes obviously Thursday's CPI, but also PCE numbers, wage metrics within jobs data, consumer inflation expectations via surveys. But potentially this gives the Fed cover to downshift to these lower increments. Of course, if inflation data doesn't cooperate, then the Fed then prefers the larger size hikes, and then this higher terminal rate above 5%, 5.25% or so. Okay, well, I just leave you with that screen. Obviously, US CPI data. I think it's also worth then looking at gold prices. They potentially will be impacted by the US CPI data for sure. Interestingly, yesterday we got a big move higher, 2% higher or so, and really a break of technical levels that we'll look at. The upside yesterday certainly boosted probably by the sell-off in cryptos. If we just go to the weekly, we can see, or even the monthly actually, we've had 7 straight weeks of declines. That was the longest losing streak since at least the 1960s, according to Bloomberg actually. We also had bullion-backed ETF holdings. They dropped to a 30-month low. And money managers actually held a net short near the highest in 4 years. Those were the figures from last week, actually. And again, we should say, really, that sort of presaged this sort of rebound, really being very, very bearish, and then a short squeeze higher, really. You can see actually on, let's go to the daily, actually, this long-term bear channel. And then the key technical levels around, actually, if we just drop to the weekly, around 1676, you can see a sort of key level of support, really, that it has been. And then on the daily, you can see we were tracking below that then, and we tapped actually some fib levels. Sorry, just flicking back between daily and monthly, weekly. But you can see actually on the weekly, we tapped actually 50% mark, 1617, a few times then in the last few weeks. That 1617 halfway mark is from the 2018 lows up to the August 2020 highs. So the halfway mark of that move is was around 1617. We tapped those a few times then, that you can see on the daily there, and then we sort of oscillated around there, but below the 1676 level before then breaking higher. Certainly then on the fundamental side, to do with the China reopening story, boosting metals. I think copper recorded its best day since 2009, and then that initial burst higher in gold was the biggest jump actually since March 2020. So you had this China reopening story, and then we've obviously had this move lower in the dollar, and also some incoming data as well, softening the rate hikes as well, and yields as well, slightly coming back, and that sort of boosted gold prices. We're now actually broken out of that bearish channel, and we're up to the 100-day moving average at 1716. Key probably going forward is, well, firstly, the September highs at 1735, they may offer some resistance. After potentially, if we do break above the 100-day moving average of that 1716, so 1716, then 1735 above there, 4 gold bugs to aim at before we get to sort of 1786 we've marked on. If we do move lower, then certainly 1676 around that area will offer key support then for prices if they do push just lower on US CPI data. Will be interesting really as we hit that long-term moving average where we go from here on the data released to tomorrow. Okay, just checking out what we should look at next. Probably good to look at sterling after the Bank of England's decision last week. They hiked by 75 basis points, pretty much as expected, but it seemed to tweak the policy message to the dovish side as much as it reasonably could, really. And that triggered a pretty strong sterling reaction down over 2%, I think, on the day, which we'll look at the chart actually in a second against the dollar. And the reaction really would have been kind of if they'd only hiked by 50 basis points. But the bank certainly pushed back quite firmly against what markets were previously pricing in terms of tightening. That was a peak rate in UK rates above 5%. And Governor Bailey emphasised in the press conference that market pricing has gone too far, adding in its forecast that following the market implied rate path could cause a 3 percentage point economic contraction over several quarters, and inflation then would end up at 0 in 2025. So the bottom line for the Bank of England, really, essentially, they shut the door on another 75 basis point hike, you'd like to think. And most really expect a 50 basis point hike in December, because certainly on balance, inflation is still far too high and interest rates must rise further. But a slowing pace is seen in hikes going forward. And you can see on this chart, the white line is kind of crisis peak implied rates above 6%. When we saw obviously the mini budget, as it were, late September, and obviously this ramp up in UK gilt yields, and we got to an implied peak above 6%, you can see there. But then obviously after the Bank of England, the light blue grey line, we're now below the September pre-mini budget sort of peak rates, and we're below sort of 5% now. This week then going forward, interesting really that well, firstly we get Friday's GDP numbers there. They'll be watched quite closely, although obviously lagging indicator really. Consensus looking for around a 0.4% quarter-on-quarter contraction, offsetting the 0.2% quarter-on-quarter growth seen in Q2. The annual measure is actually expected to reveal growth of 2.8% year-on-year. So if the back data is not revised, then the UK will have managed actually to avoid a technical recession for now. Remember, that's defined by the traditional 2 consecutive quarters of negative growth. So if we don't get recession in Q4, then because of a rebound actually in GDP likely to have followed in October, as activity resumed after the end of the national mourning period. But then we get a recession really during 2023 as higher interest rates bite against this backdrop of fiscal tightening. In a way, it's interesting then this week actually that UK assets kind of fallen out of the headlines, which is kind of good news really. Initially brought about by really the fiscal rigor of the new government in the UK and the new Chancellor. But certainly the fiscal update that we get next Thursday, I think November the 17th, will be key for sterling going forward. The drivers near term are global risk sentiment, certainly, and dollar dynamics for sterling. But as important as well, then, as I said, we get that fiscal update November 17 next Thursday, and certainly in a way tighter fiscal policy allied with, say, more dovish monetary policy further out is kind of bearish for sterling going forward. If we just look at the chart now, the sterling chart, this is, let me just grab that actually. We have seen actually on the weekly, if we just go to that first of all, we obviously fell to the fib level. If we just pull that up, last week's fib level, last week we fell to 23.6 fib level, 111.57. We got to 111.42 actually last week. And then we bounced from there, and then we're now trading above the 114.09 pandemic low, which we marked on here in a dotted line. And we moved actually, if we look on the daily, we can see we moved above some simple day moving average is simple moving average is this light blue line, 50-day moving average, and then the 21-day moving average as well, that light gray line. But we're kind of still in this long-term bear channel. If we kind of take out the spike lower really, which was on in Tokyo hours really, so very low liquidity, although obviously it did happen, we can't ignore it as a low. But really, we're still sort of trapped in this long-term bear channel. We peaked above there yesterday, tried to get above 116, didn't quite make it. And then today you can see again above 116, well, below 116, 115.66 today, and then we've fallen back down into the bear channel and looking at the 114.09 level of support, currently trading at 114.60. So interesting really, just can't quite get out of this bear channel, and the 100-day moving average is above here, sort of capping any upside, 116.68 that is, but so that's well above the top of the bear channel really. And potentially we move lower. If we move lower below 114.09, then we've got last week's lows around 114, where 20, sorry, let's have a look, 114.22. Around no, it's not 114, sorry, it's one these lows, sorry, which are around anyway, around what am I looking at, 111.51 or so, yeah, 111.42. Those are the lows if we do break then the 114.09, although we've got those simple day moving averages to contend with. Okay, I think we've covered a good deal here already. We've looked at obviously the Fed, we've looked at the US CPI data, of course, and then looked at sterling and what happens with the Bank of England potentially, the fiscal update next week, which we'll cover in a couple of weeks' time, hopefully, and potentially the technicals on sterling as well. Hope you've enjoyed the webinar. Please tune in a couple of weeks' time, and we look forward to speaking to you then. Okay, take care out there.